All right, so now we get to the fun stuff. So we're going to go through some examples. And these are rolling, this is a rolling balance sheet, rolling company. Okay? Rolling examples. The idea here is we have a number of examples, and we're going to start with example 1 and 2 and go on, and it's going to be the rolling transactions of a business, the ones that we're going to focus on. I mean, there might be other ones, but we're just going to focus on these and how they affect and just view them together. Okay? Now, we're going to ignore the tax reporting for now. We will talk about tax reporting at the very end, and of course, as you go more into the course or other courses, your tax courses, tax reporting, you learn the tax rules. And I'll show you how we combine them together at the end. But really, we're focusing on, again, on books, GAAP. So example 1, on January 1st, year 1, A and B form a general partnership that operates in a calendar year for tax and book purposes. A contributes $300 cash and B contributes $100 cash. The partnership then immediately purchases a building for $200 and land for $100 with some of the cash received. Okay? So they're going out and they're receiving $400 total in cash. Okay? Then the partnership immediately on that same date, right? This is all on January 1st. Okay, so remember, we have a snapshot at the end of the day, close of the day, sunset, take a snapshot of the business and what's there. Partnership immediately purchases a building for $200 and land for $100 with some of the cash received, right? There's $400 of cash, right? And $200 and $100 is used, so we have $100 cash left. So on our balance sheet, right, we ask first we start with assets. What assets do we have? Okay, well, that's on the left side. We have $100 of cash, right, because we started with $400, but we needed $200 and $100 to get the building and land. We have a land of $100. Remember, we use the historical cost concept. It's whatever we paid. And a building of $200. That gives a total of $400. We add them all together. Add the three numbers. Okay, and remember, this is all book. We are only doing book. So this is how it's reflected for book. This is how it's reflected generally accepted accounting principles. Liabilities, there are no liabilities so far. And then the capital accounts, right? A contributed $300 cash and B contributes $100 cash. So that's what the capital is. It's the amount of cash with respect to those individual owners. So we have our accounting equation, assets equals liabilities plus owner's equity or capital. We'll call it C capital here, right? Assets of 400, liabilities 0, capital 400, boom, we're in balance. And they equal out, and we show that. And that's what the purpose of the balance sheet is. So now let's continue on to the next example. Again, it's a rolling example. So during year 1, the partnership earns $60 of rent. And this is net of all expenses other than depreciation expense. So it actually gets this in cash amounts. And let's say it received rent, through cash, and then it also paid some expenses. Now the partners agree in the partnership agreement to allocate $45 of the $60 to A and $15 to B. That's how they're going to allocate, okay? And again, remember, we're doing book here. We're ignoring tax. We're not told yet to look at tax. So on the balance sheet, we ask, okay, what are our assets? Well, the land and building have not changed. They're still 100 and 200. But cash has changed, right? Before we were at 100. Now we get $60, right? We increased by $60. So now we have $160. So that totals to $460. No liabilities, right? We don't owe anybody outside the business any money yet. Capital. So before, A had 300 and B had 100. We're told that we allocate the rent. This is a net income, right? Or just, you can call it income, right? We have wire, W-I-R-E. By the way, in our previous example, in wire, right, the 300 and 100, that was the investment, right? Investment increased. So our equity or capital went up by 300, 100, 300 for A, 100 for B. Well, here, now we have net revenue, right, of 45 to A, 15 to B. So we add that on. So plus 45 plus 15. So we get 345 and 115. And we add those together. And we get 460. 460 equals 460. Boom, we are in balance. And that is how we report from a book standpoint. All right, we're continuing on. Again, this is a rolling example. During year 1, the book, so we're not worried about tax yet. We're not doing tax depreciation. The book depreciation for the year on the building is calculated as $20. So they calculate that we're told the book depreciation. And a lot of examples in partnership tax and other areas of tax, you're actually told the book depreciation is. You're told to this is the amount, or do straight line over 10 years. Straight line depreciation is most common, by the way, in when it comes to generally accepted accounting principles. Straight line is. As we know, for tax though, makers is more common unless it's building, then it's also straight line. But you might have different recovery periods, salvage value issues. I'm just going to go ahead and tell you here, again, it's $20. The partners agree to allocate all depreciation expense to A. Now you might be wondering, well, why is that? Income was allocated a certain way, but expenses. Well, partnerships, as you've learned already from a tax standpoint and also from a business standpoint, you can pretty much do whatever you want. It's very flexible. You can do what you want within bounds. And we're going to learn through allocation rules that as long as tax matches book, you can also follow those wide bounds as well. So they decided, you know what, we're going to allocate all the depreciation to A, that loss, and the reason why it might have something to do with maybe B is working with the building or something, A is not, and A is solely a money investor or something, right? Because A put in more money. Could be anything. So our cash stays the same. This depreciation expense does not involve cash. It's a non-cash expense. Land stays the same. So from example 2, these numbers are the same. By the way, notice, let's say the land has gone up in value from beginning of the year throughout the year. We still keep the land at $100. If it went from 100 to now it's worth 170, we still keep it at 100. If we sell it later for 170, we're going to have to report $70 a gain, but that's separate. That is a $70 gain that we report separately. So keep that in mind. Now this is interesting. Notice we have a new column. We have 2 columns rather than just one. A new column. This is called the book value calculation. So on the balance sheet, we actually show the accumulated depreciation. It says less depreciation, but this is really accumulated. It's the depreciation taken on the building over the life of the building. So here, so far, we've taken $20 of depreciation in year 1. So in year 2, if we took another $20, this would be $40, right? 20 in year 1 plus 20 in year 2. But we're only dealing with year 1. So 200 minus 20 gives us a book value of 180. That's what we report the building at as 180. We then add these numbers together and we get 440. Okay, we have no liabilities yet. And then our capital account, okay, well, B is allocated no depreciation. And you're wondering, okay, well, how does this affect capital, right? W-I-R-E. Well, this is an expense. Depreciation is an expense. Expenses decrease. So A's capital account was 345 in example 2. Now it goes down by 20 to 325. It decreases A's capital because it's the E and wire. So A now has 325. B stays at 115 because no depreciation is allocated, and we have 440. 440 equals 440. Boom. We're in balance. That is what the balance sheet, that's the purpose. All right, example 4. On December 31st, year 1. So we had all those transactions during the year. Now we're getting to the end of the year. December 31st, year 1, the partners agree to distribute $200 to A. That's $200 cash. Again, it's implied, right? It's implicit. If you're not told that it's an other asset, it's implied that it's cash. So $200 of cash to A. Now the partnership, it doesn't have enough cash. If you go back to the previous example, it does not have enough. It only has $160 in cash. It doesn't have $200 or more. It needs $200 cash to A. So what it's going to do is it's first going to borrow, before it distributes out money on this date, $50 from a bank. So that transaction, we have our first liability. We record $50 of debt. I'm going to call it bank debt because you're going to see we're going to have another debt in a moment. $50 of debt. So we have $50 of liability reported. And then we're also paying out cash of $200 to A. Remember, that's wire, right? W-I-R-E is our 4 adjustments to capital. This is a withdrawal of $200 to A. It decreases A's capital account by $200. It's a decrease. All right? So let's start on the balance sheet. We'll come back to the capital. We have our assets on the left, right? Cash, we had $160 in example 3. We just increase it by 50 when we borrow $50 from the bank, $50 cash, and we're subtracting 200 because we're paying that out to A, right? So this is the borrowing from the bank. This is from example 3. Bring that over. and we're subtracting $200. It's a distribution or withdrawal to A. Okay? That leaves us with a balance of 10. The land is still 100. That hasn't changed. And the book value of the building from example 3 is still 180. That brings us to a total of 290. 290. Okay? Then we have our liability, 50, capital of A. So in example 3, A had a balance of 325. A has just taken out $200 of cash, right? This is W. It reduces the equity or capital. That leaves us to 125. And then B hasn't changed. And that, if you add those together, you're going to get 290. 290 equals 290, and we are in balance. Boom. Continuing on to example 5. So during year 1, the partnership incurs a tort loss slip and fall of $130 allocated entirely to B due to B's negligence. Maybe B has been managing the building and something happened where one of the tenants or since they're renting or a customer or somebody slip and fell, and it was definitely the landlord's fault, which is the partnership, and it's really tied to B since B is the manager. So there's $130 allocated entirely to B. This results in a debt to the party that was injured by the tort because we don't have any cash, right? We just paid out distribution, and the court ruled the damages on December 31st, maybe after the payment for the distribution was made. So going back to our balance sheet, cash has not changed because we're just taking on a debt. We're taking on a debt, so cash has not changed. Land has not changed. Book value of building stays the same. That leaves us with a total of $290. We still have our $50 that we owe the bank from example 4, taking out $50 of cash so we could borrow, so we could pay out $200 to A. Here's the tort debt, right? We owe this party that was in the slip and fall as a result of damages in the court from the court decision, $130. That's a debt. Maybe it gets paid in the future. Okay? A still has $125, no effect. And then B, since all $130 is of this loss is allocated B, right? We have WIRE, withdrawals, investments, revenues, expenses. Well, expenses also includes losses. They decrease. This is a decrease, right? So in example 4, we had a balance in capital for B of 115. Now we have this loss or expense, and it's been incurred. Remember, because GAAP, we use the accrual method, right? This has been incurred, right? The expense is incurred. You're saying, well, it hasn't been paid yet. Well, we use the accrual method. The court ruled damages of 130, and you better believe if the court rules damages of 130, then those are going to be paid. If not, this partnership or B, you're going to jail, right? For not paying. Okay? Or bringing that, maybe not that, maybe a fine, whatever it is, right? But you get the idea, right? There's going to be some negative. There's definitely it's a legal obligation that the partnership now has specifically allocated to B, and that's why B's capital account goes from 115 minus 130 now down to negative 15 for a total of 290, right? When you add all these together, so 290 equals 290. All right, on January 1st, year 2, the partnership decides to liquidate. It says, you know what? That event, it really hurt us. $130 loss. When you view these numbers, that's a pretty big number, or pretty big amount. So on January 1st, year 2, it's going to sell its assets, the land and building, for the book value as of the end of the year, December 31st, what they were. And it uses the proceeds to pay in cash to pay debts. So first it's going to sell the assets for book value. So whatever book values we had in the previous example, right, the $100 for land and the $180 book value for building, that's what it's going to get. Now that's not realistic of real practice. Usually you sell for more or less and you have gains or losses, but I'm just making it easy here for you. Then it takes that cash, it turns around and pays off its two liabilities, right? The $50 bank liability, $130 tort liability. And then whatever cash it has left, that's what it has. Okay? So the balance sheet immediately prior to liquidating distributions, which means the last step is to pay off the owners, what they are, to the partners. So we do not have the land and building anymore. Those are gone, right? They've been sold. We just have cash. So the cash balance is, well, In example 5, we had a balance of 10. When we sold the land, we get the book value of 100. We sell the building, we get the book value of 180, right? Bringing that over from the previous problem. We pay off the bank debt, and then we also pay off the tort debt. And that gives us a balance of 110. That's the only asset we have is cash of 110. We have no liabilities. We paid them off. A's capital account is still 125, and B's is still 15. Why? Because they roll over. There was no gains or losses in this problem, and then liabilities simply just, you reduce the liabilities. So 110 equals 110. Now look at something interesting. When we liquidate, there's the steps in order. We sell off assets. We allocate gains or losses. We then pay off the creditors with the proceeds that we received. And then finally, the last step is we make liquidating distributions. We pay out the remaining cash to the owners. Almost, depending on what the partnership agreement says, but almost always in accordance with their capital account balances. Well, that's how GAAP would go, and that's also what you're going to see in partnership tax area under the regs in 1.704, which you'll learn more in a later topic, or other areas of tax accounting. So you see 125 and negative 15. There's only $110 of cash. So how is A going to get 110? Going to get 125? The partnership only has 110, and that is a good point. So what does each partner receive in liquidation? And per their capital accounts, as we saw at the end of that example, A should get 125 cash, and B should pay or owes $15 cash. It's negative cash of $15. If we add that together, that's where the 110 comes from. A's capital account is 125, but the partnership only has $110 cash to distribute. We saw that in the previous example. So what's the result for B? Does A get the 110, all the 110, and B not have to do anything? Just say, okay, well, I'm just going to leave, clear, free and clear, just zero? Or must B contribute $15 to the partnership so then A gets the full 125? Well, really, it depends on what the partnership agreement states, but almost always it would be the latter. B would have to contribute the $15 corresponding. And the reason why is this is a general partnership. We're told in the problem, if you go back to example 1, they form a general partnership, which means the partners are both jointly and severally liable, and they personally liable. They can go unlimited deficit, unlimited negative. That's going to be very important when you look at the partnership tax accounting rules. If I told you this is a limited partnership or a limited liability partnership, this would be a bigger issue. This would be a lot bigger issue, okay, just so you know. But because it's a general partnership, you have to still look at what's in the partnership agreement because partnership agreement is what's the rules. But if it's silent under state law in all the states, it would, or almost all the states, I should say, it's going to be that B is going to have to contribute $15 cash to the partnership, bringing this balance to zero, and now the partnership has 125, and then A gets the full 125 cash. Okay, so basically, B pays 15, bring it to zero, and then 125 to A, and it all goes to A. So B makes that payment. That's really how it would work out. All right, so before we finish this discussion, we just went through the book accounting for some examples. These examples we went through, very important. Please go over that again. Very, very important, very useful. Let's go back to example 1. I want to now talk about book versus tax reporting. We've been focusing on book reporting. Let's also show now how tax reporting would work out. And then the next slide, we're going to combine them together because when you start doing partnership tax accounting, you're going to have a combined balance sheet with both book and tax numbers. So let's go back to example 1. We're going to start from square one. A and B form a general partnership. A contributes land worth $300 on the date of contribution, which A purchased years ago for $100. B contributes $100 cash. Let's consider both the book and tax reporting. So under the book method or book reporting, we're going to have a balance sheet, right? We have our assets on the left, liabilities, which are zero. There's no liabilities, and then capital. So these are the book numbers. We've got cash at 100, land at 300. We add them together, we get $400. Zero liabilities, right? So liabilities are zero. And we got capital at A, 300, B, 100. Add them together, 400. 400 equals 400, we balance. Boom. What about the tax reporting? So for tax reporting, you have to consider the tax rules. Now, on forming a partnership, Section 721 applies to both the partners and the partnership, and it says no gain or loss shall be recognized by the partners or partnership for the contribution of property, which land and cash is considered property. A and B contribute land or cash in exchange for a partnership interest. The ownership percentages do not matter. We're not told the ownership percentages don't matter. So no gain or loss to A or B, right? We don't report that. We are worrying about the balance sheets. That's the effect on the company, okay? Now, remember we also learned in Section 722 and 723 that the partners in partnership, they basically carry over the basis for determining, for the partner, it's for their outside basis in the partnership interest, and for the partnership, it's the inside basis in the asset. So of course, cash is going to be 100 because the face value of cash and the basis always are the same. But the land, notice this. The land, the amount for book purposes was 300, right? Because remember, historical costs, we use fair market value on that date and we keep that going forward on the books. But for tax purposes, under Section 723, right, the inside basis of the land to the partnership, because that's, again, we're doing the balance sheet. So this is what it looks like for the partnership, not the partners. We're reporting the partnership's balance sheet. From tax standpoint, under Section 723, we had no gain or loss under 721. We carry over the basis. That's what A purchased it for, $100 years ago. That's A's basis. It rolls over. Okay? And that gives us a balance of $200. In capital accounts, for capital accounting, A gets the basis, the adjusted basis, which A is contributing the land. So that's a carryover basis under Section 722. So that carries over. It's not the 300, it's the 100. And then B is just doing cash. So the face value of the cash is always going to equal the adjusted basis for cash. That's not going to be different. So that's going to be 100. We add those together, we get $200. Now, in this case, the tax also equals, but that's not always the case. If you have revaluations or Section 704 or other issues, they might not equal. On formation, they almost always equal though, okay? So we have a balance on there from that standpoint. So the book method and the tax method, we do have some differences. The main difference is here because remember for accounting, for GAAP, we use the historical cost concept, which is fair market value, but for tax, we're using the tax basis under 722, 723. That's very important. That's that $100 in the land, and then A also has 100, not 300 there in the A's capital account. But for book, notice there's going to be this difference. So let's combine them together and see what it looks like. So in the combined balance sheet, we've got assets on the left, liabilities, which are 0, and capital on the right. So for the cash, again, face value and basis always equal, right? So tax, think of that as the adjusted basis. Book, right? That is the GAAP, generally accepted accounting principle. Same here, adjusted basis and GAAP. Okay? Now, one thing I want to note is this adjusted basis is not, in the capital accounts, will not equal the outside basis of the partner if there are liabilities, okay? Because liabilities go into the basis of the partners. Now, in this example, they do equal because there's no liabilities. But if there are liabilities, it won't equal because the liabilities come separate out of they're separated from the capital and they're allocated under Section 752 under that special allocation provisions. And we're going to learn that. You'll learn about that in a different topic, okay? But look at the combined balance sheet. We've got the tax column and the book column, right? We got our tax numbers. That came from the tax reporting, right? The 100 for cash, remember, because the face value and the base is always equal. The land, that was under 723, the inside basis. Then we have the book, the 100 cash, and we have 300 because that's the fair market value on that date. That's the book value, the GAAP. Okay, remember, 400, 200. And then there's no liabilities. And then capital tax, remember we have the 722. on that date. And again, it's because no liabilities were able to do that. But if there's liabilities, it's not that simple. And then we have our 300 for A, and that comes from the fair market value of the land contributed. Again, that's the gap, how we do it. And then 100 for B for the cash, 400, they equal. Now, before we conclude, and you're going to be seeing this type of balance sheet approach when we do the allocation discussions, at the end, I just want to go through one transaction. Let's say at the end of the year, the partnership sells the land for $350. Okay, so the land was $300 when contributed, now it's $350, and they share the gain 50-50. Let's first start by looking at the cash. Well, we had $100 of cash. We just sold the land for $350 cash. So $450, again, adjusted basis and face value are always going to equal for cash. So we have $450. Now we have no liabilities. There's no liabilities in this problem. We go to the capital accounts. All right, so there's a special rule here under section 704C, and you'll learn more about this later on. And basically it says pre-contribution gain or loss gets allocated to that respective partner that contributed the property. So since A contributed the land, and A contributed at $100, that was the adjusted basis, and it's now being sold for $350. Well, on the date of contribution, it was worth $300 on contribution. That first $200 difference, right? If we subtract 300 minus 100, we get a $200 difference. That first $200 difference gets allocated all to A. Then the amount that's beyond the $300, the fair market value, that $50, that gets allocated 50-50 between A and B. So 25 of that goes to A and 25 of that goes to B. So I show you the calculation of A, and again, this will be hashed out in a later topic, but I'm just showing you how we calculated this and how everything works out. We start with the $100 capital balance, right? That's here. That's A's capital balance for tax purposes. Then we get the $200 of the pre-contribution gain or loss under 704C. That's, again, if A was to sell that land when it was contributed, right? We were told that it was purchased for $100 and it was worth $300 at date of contribution. If A, rather than contributed, sold it, A would report $200 of gain, right, by A self. That all gets allocated to A, not A and B. Basically, the idea is that this is an anti-avoidance rule for allocation purposes, so that we can't transfer some of that gain to B and save taxes if B's in a lower tax bracket. You'll learn more about that when we do have allocations. All that gets allocated to A. Then finally, the last 50 gets allocated 50-50. That's where the 50-50 rule comes into play. So there's 25. So 100 plus 200 all to A plus 25 is 325. Now let's look at the book side. So the book side, we start with 300. So it's just 350 minus 300 is 50. And there's no special allocation. It's just 50%, 50%, 25, 25. So we go 300 plus 25 to A is 325. And then 100 plus 25 to B is 125. And for tax purposes for B, remember, all of the first $200 went to A, so B only gets that remaining $25. So we have the 100 here plus the 25, and that's it for B. And that really shows you how things work out and why it's important that you follow the balance sheet. That's why I wanted to show that example, illustrate why it's so important with the balance sheet. All right, so I hope you've enjoyed this. I hope you've enjoyed this discussion. This is really, really important when it comes to allocations. Please go back over these examples, see how everything fits together. And when you're doing allocations and other topics in partnership tax and other tax topics, it's really important to understand financial accounting. This video is meant to help show why it's so important.